Welcome everybody to Prescient Investment Management's presentation at Meet the Managers 2023. I am Rupert Hare. I'm the head of multi-asset strategies at Prescient. Prescient being a house that's been around now for 25 years, runs over 130 billion in assets under management. I'm going to talk about something which is slightly different, slightly outside of what you'll normally see from an investment manager, but something which I think is going to become more and more common as we move through the years to come. And that is systematic investing, the future of asset management in South Africa. Broadly speaking, I'm going to take you through the evolution of asset management, just a recap of where we've come in the years over the last century or so, then taking you into how we turn numbers into investment decisions, switching into running funds with what we call big data, a big catchword at the moment, so let's go through that. And then lastly, taking you into the real-life practice of running asset management, running funds with our Prescient Balanced and Prescient Defensive funds. So starting with the history or the evolution of asset management. If you go back into the early days, you started with the DCF models, that's discounted cash flows, it's the principles of Benjamin Graham and the likes. That's where you're valuing a company based on a fair value, and you're coming to a price at which you're willing to buy the company, based purely on fundamentals, as well as, I'm sure, a bit of discretionary input from the portfolio managers. Then, into the 50s, we went into risk and return, so the spectrum around risk and return, where you no longer just have an expected return, now you're looking to supplement it with a bit of risk. So is it worth the return that you're looking to gain in the longer run? That, coupled with modern portfolio theory, brought you into the realms of efficient frontiers, the Sharpe ratio, and the likes. And that's where we started to engage a lot more in portfolio construction. So how much equities do you combine with how much bonds, for example? Then we started getting into the 90s with factor models from the likes of Farmer and French. They're talking about efficient exposures on things like value indices, growth indices, extremely cheap, gets the job done, and allows investors to asset allocate into those particular types of asset management or styles. These days, though, in the 2000s or post-2000s, things really have blown up in the exponential sense. We're now going into big data, artificial intelligence, machine learning, all of these catchphrases that we're coming to know and love, but so many people don't quite understand. The key thing in all of that evolution of asset management is all of those different stages of asset management have used numbers in some way, shape, or form. All that's changed now is that numbers are becoming more and more readily available, and therefore you have to have efficient systems to process all of those numbers. So that's broadly speaking the history or the evolution of asset management through time. Now I'm going to take you through some examples of turning numbers into actual investment decisions. But first, a bit of a step back into the philosophical sense. What do we think at Prescient the benefit of systematic investing is in terms of thinking and thought processes? So a great book to read, Thinking Fast and Slow, separates your thought processes into two individual sections. The first being System 1, which is fast, and the second being System 2, which is slow and more ponderous. So fast is generally subconscious, it's automated, it's everyday decisions, but it tends to be error-prone. So it's things which become essentially reflexes. As you repeat them again and again, it becomes a reflex in how you do business or how you do life. System 2, though, is conscious, it's effortful, they're complex decisions, and they're generally seen as more reliable, but they're slow. So that's where you sit back and you have a sip of coffee and you look to think, what am I going to do with my portfolio over the next month, 2 months, 6 months, over the next lifetime? For us at Prescient, what we try and do is to combine the best of System 1, the fast thinking, and System 2, the slow thinking. So System 1, fast and automated, our processes are all automated. System 2, conscious, complex, and reliable, we spend a large amount of our time doing the research, putting in the numbers to see whether those investment decisions actually make sense in advance. So systematic investing, broadly speaking, quite a good definition from BlackRock. I'll summarize it, but what it's saying is that data-driven insights based on scientific testing and disciplined portfolio construction techniques are, broadly speaking, how we define systematic investing. So emphasis on data. We spend a lot of our budget and time on both data and the processing of data. scientific testing, we generally employ people from scientific backgrounds. We've got 23 quantitative analysts on the floor at Prescient, and disciplined portfolio construction. So there are no biases or any sort of embedded bias within a portfolio manager that slips into the portfolios. What that means for us, and this essentially summarizes what I said, is that we're rational, rules and evidence-based, and data-driven. Very, very important to say that we're data-driven. A large amount of Prescient's day-to-day is in data. And that, for us, we think, leads to unbiased decisions, clear strategies and processes that are 100% transparent. So we're not sort of a black box, systematic asset management firm. We're very transparent in the decisions that we make and how we come to those decisions, which in turn, we think, at least, leads to consistent long-term outperformance. So that's turning numbers into investment decisions. Now let's switch that into systematic investing at Prescient. So systematic investing at Prescient essentially leverages off our 4 core skill sets and brings them into a much more efficient manner of running portfolios. So the first one being asset allocation. That's where I spoke about the mix between equities and bonds. Very, very important to get that right, especially within a multi-asset portfolio. Then you've got yield generation, which is Prescient's bread and butter. We've been in this game for 25 years. Generally, we are quite good at yield generation in the active fixed income space. So we look to port that on top of our passive equity and property exposure. Risk management and derivative overlays, they essentially go hand in hand. We've been implementing portfolios using derivatives for multiple decades, and we see that in some cases, in fact in most cases, to be the most efficient way to get portfolio exposure, but more on that later. So talking broadly around data science, at Prescient we process over 110 million data points a day. That's over 250,000 time series, and that grows every single day. We have a dedicated data science team that sits within the investment team, so not a satellite office of data scientists, and over 100 years of collective experience as a team. I'm going to take you now into a real-life example of how we use that, let's call it big data, in real life in running portfolios. So this is how we run what we call our Prescient economic indicator, which is a real-time estimate of GDP. What does that mean? Well, GDP generally comes out 2 to 3 months in arrears. You'll see the end of Q4 GDP printing at the end of February, for example. And that's, in essence, old news. So by the time that GDP print comes out, you've incurred that, let's call it a negative GDP growth rate, which means that you experienced a recession, but 2 months ago. So really old news in terms of how asset management works. What we do using our what's called a nowcast of economic activity is that we combine as many data series as we can into finding a commonality through what's called a Stock and Watson model and to extrapolate that trend of GDP growth, but in real time. So let's take you through some examples. We use things like survey data, so PMI, consumer confidence. We also use inputs from labor markets, for instance, payrolls data or new hires, production, manufacturing, mining, and agricultural outputs. From a trade perspective, we're looking at things like exports and imports, particularly important for a country like South Africa, which is so export-orientated. And then from other activity, this is where I find quite a bit of excitement and development going forward. We look at things like railway and port traffic. We're looking into things like satellite imagery. All of those sorts of data science or data sources are becoming more and more accessible as we move through the years. So it's all about positioning yourself, positioning your team to be ready to capture those sorts of new information sources. What does that look like? So this is a lot of noise in one chart, but what it's showing you is the real GDP. This is for the United States, printed in blue, as if it was known at the release date. And then the Prescient economic indicator, the nowcast of that real GDP, as we've estimated it at that particular release date. You can see that those lines track quite closely. We're never going to get 100% right. If it was 100% right, I'd be retired by now. But we are trying to track that as closely as possible. What that looks like when we do a regression, so now we've got the y-axis being real GDP growth rate, the x-axis being the Prescient economic indicator, we can extrapolate, as of today, what our real GDP nowcast is. So that's 1.01%, which is below long-term average trend growth in the United States, but it's above zero. So that means the United States is not in a technical recession as of today. This could change tomorrow, but it is below average trend growth, which is generally quite bad for growth assets like equities and property. So what do we do with this? I mean, do we just throw this at the wall and then have a coffee and talk about it? No, that's not exactly what we do. This then gets used within our models for asset allocation, and I'll take you into that in a bit more detail. So by way of example, this is our model on South African equities. We run 29 different asset classes at last count, but this is our model for South African equities and where we currently stand. So quite self-explanatory. We're currently neutral on South African equities, which means that we don't take overweights or underweights in South African equities. And we build that up using 4 pillars. I'm not going to call them fundamental pillars because, number one, valuations includes fundamentals, but there are 4 pillars of drivers of financial returns. The first being valuations, which includes fundamentals and things in fixed income like yields, inflation, etc. And then in the economic front, we use growth estimates. So for example, that Prescient economic indicator where we're trying to estimate the growth outlook currently for South Africa or the United States, that falls within the economics family of variables. Then financial conditions, that's where we're looking to model the propensity for global markets to take risk. There we're looking at things like spreads. So for example, spreads of investment grade credit over simple central bank. And that tells us the appetite for taking risk amongst financial markets. And the last one, which I always say is the most important, is sentiment. And the example that I always give is that we can be positive on valuations, we can have a really good economic growth outlook, we can have positive financial conditions, but if everybody in the market is bearish, the market will sell off. So very important to keep sentiment in mind as well. And those 4 pillars are what drives our view on every single asset class. Digging deeper, this is our model on SA equities. So for example, the valuations column, you'll see things very similar, very conceptually related to what our peers do. So things like the price to earnings ratio, currently in South Africa, pretty low. I'll show you that, which means it's blue, i.e. positive for us. Whereas the Prescient economic indicator in the growth side is red, which shows us in South Africa there are headwinds towards economic growth. And then consumer sentiment in South Africa, I think we all know it. You're sitting in the dark for 6 hours of the day. Consumer sentiment is surveying negative. So all of those aspects are important when looking at an asset class, and we combine them all together. Price to earnings ratio, I mentioned quite attractive. This is what it looks like through time. Generally, when you've got a low PE ratio, it's attractive because you've got a shorter time to pay out if you simply get earnings in an equity or an underlying stock. But also, it gives you quite a good indicator of the deep value that might exist in South African equities. So for instance, right now sitting at 10 times, which is over time quite a low point, which looks like South African equities are very attractive. But there's another side to that coin in that the Prescient economic indicator, the growth outlook for South Africa has been declining, which suggests that you could be involved in a bit of a value trap, right? So a low PE ratio can be low for a reason. So important to take all those different aspects into account. Then if we look into the models themselves, are they actually are they viable? This is the sort of thing we look to build, our analysts look to improve. So those indicators that we aggregate come into one overall model, and then we test that model versus market returns. And what we see here is a distribution where our strong negative views have generally led to underperformance of the market, and our strong positive views have led to positive performance in the market. And that's exactly the type of picture we're looking for. So we can, with some degree of statistical significance, obviously it's never going to be a sure thing. We work in the world of probability, but if that probability is more than 50%, then we've got a strong hit rate. So here you can see quite a strong model for South African equities. Okay, so that's an example of how we build in different data series into getting a view in each asset class. Let's now dig into running actual funds with big data. So what we do at Prescient is that we look to combine this age-old argument of should you go into passive or should you go into active into one offering. How we do that is that we have ultra-low fees, so 30 basis points, which is equal to, if not less than, quite a few of the actual passive products. Low transaction costs. We don't trade single stocks. That's important to note. We don't trade single stocks at all. We generally trade at an index level. and a low tracking error to the general peer group. We're looking to give you the peer group average plus a little bit over time. And that's what we call a humble approach to asset management. Then on the active side, we are very much active. So we run our own strategic asset allocations, which is our efficient allocation of capital. A good example around that is changes in Regulation 28 allow us to take more offshore exposure. So what do? We take our systems, which are predefined, pre-built, we rerun the portfolio optimizations, we find the new optimal portfolio, and then we shift the portfolios to have more offshore exposure. And we are not afraid to trade. Our TIC is still 50 basis points, so our transaction costs are extremely low. And as I said, we do that because of the underlying instruments that we actually hold. Then we've got tactical asset allocations, and that's essentially what I showed you in that South African equity model. We take tactical asset allocations in each asset class, but they're measured. So this is not in any way a flexible fund. This is very much a core type solution within a portfolio. So when I say we've got 25% South African equity exposure, we're not going to go from 25 to 0 and 0 all the way out to 70. What we're going to do is we're going to sit at that 25, and then when South African equities are attractive, we'll go to 30, and when they're unattractive, we'll go to the minimum of 20. Why we do that is that, again, we're humble asset managers. We acknowledge that we don't always get things right, and that's important because if you were to go to 0% equities, 100% cash, and then the equity market rallies by, let's say, 20, 30%, you'll be lagging your peer group. So we look to give you that core solution within your portfolios, and not too far off what you think it is. So what I always like to say is we stick to our knitting. The last one is fixed income alpha. We are traditionally a fixed income house. It's where we think we can add significant and consistent alpha. And that's why we are active on the fixed income front. We have passive exposure to things like South African equities, global equities, property. But on the fixed income side, we generally are more active. So there we're playing the yield curve. We're getting exposure towards different asset classes within fixed income, credit, unlisted infrastructure, and the likes. So now digging a bit deeper into how we run the funds. So we focus very much on a top-down investment policy, which is not, it's quite unlike what a lot of our peers do. Many of them are bottom-up. Pick the stocks, put them all together, get towards your overall portfolio. We focus first and foremost on the combination of asset classes. So how much by way of equities and bonds do you have? And that, if you do the maths behind it, actually explains almost all the variation of your total portfolio returns. This is in the United States, study done in '86, so quite a long time ago. The most recent one that we've done in South Africa, it explains around 78% of the variance via asset classes, not market timing and security selection. So it's not whether you pick, let's say, 10% or 12% NASPERS. That's not the biggest decision that you have to make in multi-asset. It's whether you pick 60% equities or 20% equities. So that's where we focus first and foremost our attention within these funds. Just taking a little bit of a step back into the world that we now see in South African asset management with changes in Regulation 28. And this just talks towards why we don't pick stocks, and I think something which is perhaps going to be a little bit more of a common thing, a common trend within asset managers going forward. If we take global equity exposure, or if we were to be single stock pickers in the global equity market, if you just combine MSCI World, MSCI Emerging Markets, you get 3,350 names. So where do you even begin? How do you have specialists in every single market who can pick a stock for you? There's going to be more and more of a quantitative overlay, even within the more traditional asset management houses. For us, we don't pick any of these stocks. We get exposure to all 3,350 of them. So that's how we allow ourselves to get the maximum amount of diversification within our asset class exposures. And that actually leads me into the next slide, which talks towards that initial statement I made about the majority of variance being explained by asset allocation. This talks towards why we generally have less South African equity exposure and more offshore equity exposure. And that's a decision that we made after the changes in Reg 28. It was both a philosophical decision based on the slide I showed previously, where there's a lot of concentration in South African equities, essentially 40 names that you're getting in a liquid format. So if one of them goes south, your portfolio takes a massive hit, despite being a balanced portfolio. And then also mathematically. So if you go offshore into the more broadly diversified indices, you get that exposure to 3,300 names. You also get exposure to multiple countries, which reduces your risk from a volatility perspective by 1 to 2%. So makes sense on both fronts, and that's why we went offshore. Other differentiating factors in our strategic asset allocation, we have exposure to clean energy and infrastructure, very topical at the moment. That's where we're getting exposure to things like wind and solar farms, very attractive CPI plus 5%-ish yields, and a very, very straight line accrual method. So that is for us a very good base asset within a portfolio. Offshore, we've got 35% exposure towards a mix of developed market and emerging market equities. We've got an exposure to developed market bonds, which acts as quite a good insurance policy in a sell-off. And then, for me at least, quite importantly, or most importantly, is our currency hedging. So we go the full 45% offshore structurally. This is before we take tilts. But we also take a currency hedge of 20%, which means that we don't participate 100% in that dollar-rand exchange rate. And it allows us to invest in things like US Treasuries at US Treasury dollar-like volatility, which is around 4%, 3 to 4%, instead of investing them at 18%, which is what happens if you invest directly via the rand. So quite a good tool in the toolbox to have, and something that we have done for decades. Okay, so then we've got our strategic base, our anchor portfolio. From there, we take tilts. This is our views that we come in and we see them in the morning based on those asset class models, one of which I showed you earlier. You can see at the moment, for example, we are strongly negative on US equities. That means that we shave off some of the US equity exposure that I showed you on the previous slide, and we rotate it into something else that's quite attractive. For instance, SA nominal bond exposure. So that's how we look to give you 50 basis points to 1% pickup through the cycle from our tactical asset allocations. I talked a bit earlier about why we prefer fixed income or active fixed income asset management over active equity asset management. And this really summarizes it, and these are not my numbers, so this is courtesy of Spither, which is the S&P subsidiary. Research done into South African asset managers, but this is a global phenomenon, about how many of them have performance above and below benchmark in various categories. So the one on the left is equity. It's our general equity category in South Africa. And what it shows us is that over the last 10 years, only around 30% of those active equity managers have managed to beat their benchmarks. And that's because of various reasons, fees not being the smallest of reasons, and I'll show you why that is in a couple of slides' time. But it's very, very difficult to beat the benchmark if you're an asset manager in the active equity space. There are obviously some guys that do, and there's some amazing managers in South Africa, but we don't think we have that skill set. So where do we focus our time in the active space? We focus in fixed income. So there, over the last 10 years, 77% of managers have beaten their benchmark, a lot more consistency. And I mean, sure, they don't beat their benchmark by 20%. That's not the nature of fixed income. It might be by 1% in a particular year. But for us, that's the key, in that it's consistent. So it's 1% every year, instead of making 20% one year, and then the next year, 15%. So it's about the journey within a multi-asset fund. The next topic I wanted to just cover is fees. Very topical, always presented by the pure asset managers who are running passive strategies. But for us, we're running active strategies in that kind of passive area of fees. Just to give you some perspective of asset management around the world, South Africa, average TIC in the multi-asset high equity space, 1.27%. The United Kingdom, 85 basis points, and the United States is 58 basis points. So less than half the TIC, or the TIC equivalent in the United States, compared to our South African multi-asset high equity funds. So something has to give, right? Over the next couple of years, we expect that to happen, and we put ourselves well ahead of the curve. We charge 30 basis points management fee, and our overall TIC in the balanced fund, 50 basis points, and in our defensive fund, 52 basis points. So even cheaper than the United States balanced fund market. Again, I always joke, I'm not going to retire anytime soon. But, I mean, that for us, we think is a fair fee and a good product offering for end clients. Just comparing fees versus consistency, quite an interesting chart. I've seen some of our peers present quite a similar type of chart, especially in the passive side. So this is your TIC on the x-axis, so how expensive funds are on an overall basis to investors. You can see there's some extremely expensive funds, as far out as 3 and a bit percent. A lot of them have got performance fees within those underlying fee agreements. But on the far left, you've got generally the passive funds and the funds like us who charge extremely low management fees and play within that passive area. What I wanted to highlight, though, is on the y-axis, that's consistency. So that's time above average over a rolling 1-year period. That's the type of consistency you're looking to get for your clients. They don't want to sort of enter at the top of the roller coaster and then exit at the bottom. You're looking for consistency. And what I wanted to show you is that there's a direct relationship between consistency and charging lower TICs. Again, there are some great managers who've got high TICs in the top right, but on average, that blue line that I've plotted has quite a high R squared. In other words, it's statistically significant, and it's downward sloping, which means that if anything, on balance, the easiest way to make your clients more alpha is just to select asset managers with lower TICs. Looking at us versus peers, apologies, the gray lines are quite hard to see in this, but this is us versus Inception, Prescient Balanced Fund, approaching 10-year track record. This is us versus the peer group, so a CISA high equity. And what you can see within this track record is that we've been consistently compounding through those sources of alpha, so that being extremely low TIC, an efficient strategic asset allocation, tactical tilts, and fixed income alpha. We've been slowly but steadily compounding that alpha profile all the way to the top. We've never won a Raging Bull. I don't expect to win a Raging Bull. If there was a 20 or 30-year Raging Bull, perhaps I might expect to win one, and that's how this product is designed. It's a sleep easy type product, which gives you just above average performance and compounds that through time within the high equity space. Just showing that through a different lens, what we have now is a stacked bar chart which shows rolling performance rankings. So 3-month means that you've got the rolling 3-month performance and the amount of time the fund has spent in each quartile. And what I wanted to highlight here is that whilst the fund may have had below average performance over the very shorter terms, that's generally a random process. Let's call it a random walk if you want to go into statistics. But the key there is that you want to try and be above average more often than not, which we have achieved. So more often than not being above 60% of the time on a 3-month basis, we've been above average. There are always going to be those tail events where you've got some sort of underperformance because of whatever the reason might be. But if you're above average more often than not, you can see the effects of compounding through that sleep easy type product, where you're getting out to the 3-year period, you've only had around 7% below average. 5 years, never been below average. 7 years, almost always been top quartile. And that's exactly the type of product we're looking to deliver for a client. So where does this fund stack up? Where should it be positioned within a portfolio? Well, we think that it makes quite a good core type solution for a client. It reduces the overall client's fee load, and it allows you to be a lot more active in allocating to managers around us. So it gives you this core allocation where you get what it says on the tin, and you don't have to worry about it. And then you can allocate towards, let's call it a passive bond fund to take advantage of extremely high yields, or be it a value manager if value looks extremely attractive, a resource specialist when platinum groups are looking attractive as well. So that's generally where we see ourselves within a portfolio as a core offering and something which we see as an anchor for investors. So taking you through just as a roundup of what I've covered. So we see this product as a core solution with extremely diversified exposure. The general overall number of holdings within this portfolio, if you do a look through, is well north of 5,000, looking into the different indices that we invest in. So extremely diversified amongst both individual names and also geographies. I often get the question, oh, what's the point of investing in offshore fixed income if SA government debt is never going to default? That's not the point. The point of that is that you get a yield curve which is just the South African yield curve, and you'll get hit at all points on the yield curve if there's a parallel shift. So why concentrate yourself 100% in that yield curve when you can also get other yield curve exposure? So that's quite a good example of diversification in fixed income. Then we like to take small measured tilts based on big data. That's where I showed you the asset class models, taking tilts when things are attractive, underweight when they are unattractive. Fixed income consistency, So there, we're delivering that fixed income, consistent alpha profile over the benchmark instead of taking active equity bets amongst single stock counters. And then the last one, low fees, the easiest way to deliver that constant alpha profile within multi-asset high equity. And that's us at Prescient. Thanks very much for listening to us today, and all the best.